Okay. Oh, I need to publish it. I didn't realize the chapter 6 practice wasn't live on Canvas, but it should be now, so you may have to refresh your Canvas page. But you should see a chapter 6 practice. Okay. Okay, so the first example we're going to do is we're going to value inventory using FIFO method. So first in, first out. So as a review from last Thursday, when we actually make a sale, we are going to cost our inventory using first in, first out. So the first units that we cost out are the first ones we purchase. Okay, so under FIFO, when we make a sale, we start with our beginning inventory and then work our way down. So in this one, they give us November transactions. So we have beginning inventory of 120 units at $39. That's the cost. On the 10th, we make a sale. The 15th, we make an additional purchase at a different cost. The 20th and 24th are sales, and then the 30th is another purchase. So again, we're doing perpetual inventory system, which means we update inventory and cost of goods sold with every purchase. So again, we're not doing the journal entries on this one, but your journal entries are the same as they were in chapter 5, as far as, purchases, logging them into inventory and all of that. So we have a little table to fill out the fun cost of goods sold schedule. So we want to figure out the cost of goods sold for each sale and inventory balance using FIFO. Okay. So when we start out here, and I apologize, it's a little small to be able to fit it on the screen. On November 1st, we're just logging the beginning inventory. So on November 1st, the only thing we have is the right-hand inventory situation. Sorry, my allergies are trying to kill me, I think. So our beginning inventory, we have 120. And then the unit cost is $39 per unit. And so then when we do our inventory total cost, we just multiply. So 120 units at $39. So you should have a total cost of $4,680. $4,680. When you get to November 10th, it tells us we made a sale of 90 units. Well, we only have one inventory price point right now, right? Just that beginning inventory of 39. So when we make that sale on November 10th, those are all coming out, bless you, of the 120 that are $39. Okay, so that's the only price point we have in inventory. So on November 10th, when we make a sale, we sold 90 units, and they have to be the $39 units because that's all we have. So what is my cost of goods sold on that sale?
3510.
Very good. 3510, 3,510. So again, we just multiply 90 at $39 each. So again, that's what we would journalize as cost of goods sold is 3510. And then we just need to update our inventory after every sale or purchase. So we had 120, we sold 90. So how many do we have in remaining inventory? We had 120 and we sold 90. 30, thank you. So we have 30 left, still at the $39. Okay, so then to calculate our ending inventory after that sale, we just take 30 times 39, 1,170. Those two entries would honestly be the same under any method because we only have one inventory cost level. Okay. Then we go to the next date, November 15th, where we made a purchase. Well, we purchased 140 units, and our cost was now $40. 140 at $40, so $5,600. So when we make a purchase, it goes on the left, 140 at $40, total $5,600. Well, we didn't have a sale there, so all we have to do is update our inventory, okay? So over on the right-hand side, we still have the 30 units at $39 each. So I carry that down. That's my beginning, my first purchase. And then on the second line, I'm going to put this new purchase. Okay. So we have 140 at $40 each for $5,600. Okay. So now I have two different price points in my inventory. On November 20th, we sold 110 units. Okay. So how many of the $39 units did we sell? All 30, very good. So under FIFO, again, we start with our beginning inventory. So on November 20th, if we sold 110 units, we get rid of those first inventory first in, first out. So we're going to know that we sold the 30 at the $39 level. And it's still the same cost of goods sold, the $11.70. And then how many did we sell of the $40 units? 80, very good. So we sold 110 altogether. So 110 minus this 30 is 80. Okay, so that's where we get 80. So the remaining 80 from that sale are at the $40 level. Okay, which is what, 3,200. Okay. So again, on November 20th, we sold 110 units. We start with what's in beginning inventory first. So we're going to sell all 30 of those $39 units. 110 minus 30 leaves 80 left in the sale. So the remaining 80 come out of the $40 unit inventory. Okay. And then the line below that, you're just showing what's left. So, no, that's November 24th, isn't it? Sorry, I'm like, what is that? Kind of getting off there. I'm like, what's going on? We show the ending inventory over on the right. So we have 0 left at the $30 level, so we don't have to list those. How many do I have at the $40 level? 60. Very good. 60, right? We had 140, we sold 80. So now we have 60 left at $40 or $2,400. So that was after November 20th. So at the end of that sale, we are down to one inventory price point again, okay? So then on November 24th, we made another sale of 45 units. So those all have to come out of the inventory right now, the 60 units at $40 each, okay? So on November 24th, all 45 come out of the $40. That's the only price level we have. The total is $1,800 cost of goods sold. So how many do we have left in inventory now? 15. Thank you. So 60 minus 45, we have 15 left at $40. That's 600 in our inventory. On the 30th, we made another purchase. So we're over on the left-hand side. We purchased 160 units. And they told us we purchased them at $43 each. 160 units at $43 each, 6,880. 6,880 should be your total purchases cost. So after we make that purchase, we just need to update our inventory again. So we carry down the 15 at $40. And then we pop in that new 160 at 43. Okay. And then on November 30th, they just want us to balance So they want our total cost of goods sold for the month. And then they just want our ending, they just want, oh yeah, our ending inventory balance. Okay. So cost of goods sold. How much is my total cost of goods sold? $9,680. Thank you. $9,680. Okay, so we're truly just adding up just our cost of goods sold column right here. Okay. So our total cost of goods sold for the month of November was $9,680. And then on inventory, we don't want to add up all the inventory because that's fluctuating. We just want to calculate our ending inventory. Okay. So we had $600 plus $6,880 in our ending inventory. So our ending inventory balance should be $7,480. Any questions on that? That's FIFO. Does it make sense? Really just kind of making sure you stay line by line, right, and stay on track. B, it just says, based upon the preceding data, would you expect the inventory to be higher or lower using last in, first out? Lower. Lower, good, and why? Gotta love the why, right? Yeah. You're like, I guessed, and it was right.
Based upon the preceding data, the prices were increasing on inventory, but since you're doing lots in, your more expensive stuff is getting sold before your less expensive stuff.
Very good. No, that's perfect. That's absolutely right. So again, yeah, she's absolutely right. Since prices were increasing every time we made a purchase, if we used LIFO, we would be costing out the more expensive costs first. So the inventory would be lower under LIFO, and the cost of goods sold would be higher. Very good. It's a little bit the good old critical thinking aspect of the inventory methods, right? It's like, oh yeah, okay, that makes sense. Alrighty, on to the next one. So the next one, we're looking at LIFO. So we're actually going to see an example. If you notice, I try to make the practice easy. We have the same sales data, okay? So now we're just looking at it from LIFO instead of FIFO. So again, when we use LIFO, we're talking about last in, first out. So here we're going to cost out the most recent purchases first, okay? So again, it starts out the same, okay? Under LIFO or FIFO. On November 1st, you're just putting in inventory balances. So you have the 120 quantity at $39. So your inventory total cost should be $4,680. $4,680. On November 10th, when you make your first sale, we still only have one inventory cost level. So it's the same as FIFO too. So that one's kind of easy. So we sold 90 units. So the only price point we have is $39. And that would be $3,510. So 90 units at $39, $3,510. So again, my updated inventory would be that I had 30 units left. 30 units left at $39, $1,170. So again, those two, really even the first three, stay the same because the next one's a purchase, right? So when we purchase, again, we're just logging that in. So on November 15th, we had 140 quantity purchased at $40 each. So our total cost is $5,600. $5,600. And then again, we just need to update our ending inventory. So we carry down the 30 that we had at $39. And then we put in those new 140 at $40. At $5,600. So then we get into the LIFO stuff on the next one when we actually make a sale. So on November 20th, we sold 110 units. So which inventory price point would I have sold? The $39 or the $40? The $40, very good. So again, under LIFO, on this one, on November 20th, we sold 110 units. Under LIFO, we take our most recent purchases, or those that we purchased last, and comp them out first. So all 110 come out of that $40 price point under LIFO. So your total cost is $4,400. Okay. So under LIFO, we always take the cost out of the last purchases first. So on November 20th, our ending inventory, we still have the 30 from beginning inventory at $39. And then how many $40 units do we have? How many units are left at the $40 price point? 30. Good. So we had 140, we sold 110. So we have 30 left at the $40 price point, which would be $1,200 total. Under LIFO, on November 24th, we made another sale of 45 units. So which units would I cost out first? Which price point? The $40, yeah. So again, we're still with the same inventory. So we're going to start from the bottom up. So all 30 of the $40 units will get sold. And that's $1,200. So how many will get sold at the $39 price point? We sold 45 total. 15, good. Okay, so 15 were sold at the 39 price point. So 15 times 39 should get 585. So on November 24th, we sold 45 units. Well, we have to work from the bottom up. So all 30 of the $40 price point got sold, and then the remaining 15 came out of the $39 price point. And so we only have, what, 15 left at the $39 price, which is $585. And then November 30th, we're right back just logging a purchase. So we have 160 units at $43. So your total will be $6,880. $6,880. And then we just want to show that in our inventory. So we still have 15 units at $39 for $585. And now we have 160 units at $43 each for $6,880. So what is my total cost of goods sold using LIFO? Very good, thank you. $9,695. So again, we just added up that cost of goods sold column there. There's 4 sales, well, really 3 sales, but 4 different prices. So our total cost of goods sold under LIFO is $9,695. And then on my inventory, my ending inventory is the 585 plus the 6880, so 7,465. 7,465. And since we used, when we did FIFO, we had the same numbers just to give you a comparison. Under FIFO, we had a cost of goods sold that was slightly lower, 9,680. But then our inventory was a little higher at 7,480. So really only a $15 difference both ways. Well, $15 in inventory. So $15 both ways. So you can kind of see this one's not a vast difference on LIFO and FIFO because prices weren't fluctuating that much. But again, you know, when we're dealing with LIFO, we're going to, if prices are increasing in the period, cost of goods sold is higher under LIFO. Okay. And what that means is then that your net income will be lower under LIFO. Okay. So it's good to kind of understand that, and we'll talk about that when we review Thursday as well, but just kind of you can understand like prices. We'll only look when prices are increasing, so we don't have to get confused on increasing or decreasing. But in a period where prices are increasing, LIFO does result in a higher cost of goods sold, and therefore a lower net income or gross profit even. On these, I know it doesn't really talk about the actual sales price. I think the ones on your homework, though, you know, these are just kind of the practice. But just know, this is all the costs that we paid, our purchase price, okay? They didn't give us the sales price that I saw. But on your homework, they may tell you how much the sales price was. You know, maybe like $50 a unit. So you might have to calculate like total sales. So you would just add up how many units you sold in the period total, multiplied by that sales price to get kind of total sales, okay? And then you could subtract out cost of goods sold to get your gross profit. So just a heads up on those, and, you know, and we'll review that too on Thursday, but, you know, it's good to understand. Remember, we learned that, you know, sales minus cost of goods sold equal gross profit last chapter, but, you know, if it didn't stick, here it is again, right? you get another shot at it now. You guys are good. Any questions on LIFO? You guys good? All right. You guys are really quiet. Is it the weather, or just done with the semester, or both? It's like that time of year, right? I'm like, y'all are looking at me like this is great. Yeah, we're here. It's really fun being here today, right? It was hard getting out of bed. It was, and then like I said, my allergies, my throat was all like, so it's like I had green tea instead of coffee, and I'm regretting that choice right now. Oh yeah, I'm gonna have to go like chug a Coke Zero or something. It's good times, right? Should we get up and like, you know, move around? No, like no. Can we just get through this? Is that where we're at? Can we just get done? Stop talking. Just finish. Oh. I'm just trying to get through the day too, and you know, seeing all you like. I totally get it. Okay. I always say, you know, I know students, you know, you guys are really ready, but us professors are right there with you this time of year. You know, we're all like, yeah, we're kind of just like done too. So, shouldn't admit that, right? But it's true. And it's not about like coming to class, it's just like the whole like getting up and, you know, yeah. When it's raining. Okay, we'll move on. So the last costing method is the weighted average cost flow method. Again, this one's going to smooth out price fluctuations, you know, that we see in LIFO and FIFO. So what we do here is every time we have inventory coming in at different costs, we're going to calculate an average cost for the inventory. Okay. I don't know why they switched it up, but now it's pretty and like in some green little table, but it's the same kind of information. We do have different data on this one, and they didn't have one that was the same sales data. So here we have for a whole year, we have beginning inventory January 1, and then sales and purchases as we go through. So we're going to calculate cost of goods sold using the weighted average method, okay? This one, I have to kind of scroll. I don't want to make it too small so you can actually see it, hopefully. Okay, so on January 1st, we're just logging the beginning inventory. So we have 4,000 units. Our unit cost is $20 per unit. So our total inventory cost is $80,000. Okay. So that's just where we started at the beginning of the year. So then on April 19th, it says we sold 2,500 units. Well, again, this would be the same under any method because we only have one price point. So on that April 19th sale, all 2,500 of those are going to be at the $20 unit cost. So our cost of goods sold on the April 19th sale is $50,000. Okay, $50,000. And then we just need to update our ending inventory. So we had 4,000, we sold 2,500. So 1,500 are left at $20 each. So our total cost of $30,000. So ending inventory is $1,500, $20 each at $30,000 total inventory cost. Okay. So again, that's the same under any method that we use. On June 30th, we purchased an additional 6,000 units. So we have a 6,000 purchase, and these we purchased at $24 each. So we multiply that, our total inventory cost there was $144,000. So now when we're doing our inventory, what we need to look at, and they don't really show it on the little chart, but what you're doing is you're going to actually look at, you have in inventory, you have 1,500 units at $20, right? For a total cost of $30,000. And now we have an additional 6,000 units. 6,000 units at $24 for a total cost of $144,000. So what they want us to do is just come up with a weighted average, okay? Well, to do that, I'm going to total up. I have a total of 7,500 units, so that's my total units. And then I'm going to get my total cost. Okay, so my total cost is $174,000. To get the average price per unit, you're just going to take your total cost, divide by your total units. Okay, so your average price per unit is going to equal your total cost of $174,000 divided by 7,500 units. So your average price is always total cost divided by total number of units. And then they tell us, if necessary, rounded to decimal places. So what is my average price per unit? My average cost. Very good, $23.20. So again, over here, I am going to put in my total. So I have 7,500 units total at an average cost of $23.20 each. And for our total cost is the $174,000. Okay. So average price, $23.20. Okay. Everyone got that? Okay. So now we have that average in there. On September 2nd, we sold 4,500 units. Well, the good news is we've already calculated the cost. So the cost is the $23.20 average. Okay. So the cost is $23.20. So our total cost should be $104,400. So 104,400. And then we had 7,500. We sold 4,500. So we still have 3,000 left at the $23.20 cost. So now our ending total inventory cost should be $69,600. $69,600. So once you calculate that average cost, you're just using that when you make the sale the next time. So then you use that price point. So as long as you write down how to calculate your average cost, it's not too bad, right? Taking an average. Pretty easy. And then on November 15th, we made another purchase of 1,000 units at $25. So 25,000 total cost. 25,000 total cost. Well, anytime you make a purchase, you have to re-average, okay? Because you always want your ending inventory under the weighted average to be an average cost for your whole inventory. So here, we want to do a new average, okay? So, let's see. So we already had, what do we have? We had 3,000 left, right? 3,000 left at the $23.20 cost. So the total cost there was the $69,600. And then we just purchased 1,000 more at $25. For 25,000 total cost. And again, we just add up our total units. So all total, we have 4,000 units. Add up our total cost. 94, right? So we add up our total units and add up our total cost. And then again, we're going to take total cost divided by total units. So 94,600. Divided by 4,000. And again, we'll round it to 2 decimals if necessary. What's my new average price per unit? $23.65. Perfect. $23.65. Okay. So that's what I'll log. I'll log my totals over here in my ending inventory. So I have a total of 4,000 units. At now $23.65 per unit. Now we've already calculated our total cost, the $94,600. $94,600. So then the last line is just balancing. So we want our total cost, which is our total cost to get sold. So 50,000 plus the 104,400. So 154,400. So we always add up our total cost to get sold. And then on the inventory, we just want the ending inventory. Well, that we can just carry down because we just averaged it. Okay. So in our ending inventory, we have 4,000 units at $23.65 for a total of $94,600. So again, under the weighted average method, you're really going to see when prices are going up, the weighted average total cost of goods sold and inventory will be somewhere in between LIFO and FIFO. So truly just kind of smooth out those price changes. Okay. Any questions on that? It's not too bad, right? Doing the math, right? It's always the fun part. All right. Okay, so those were the three methods. You know, we had first in, first out, last in, first out, and then our weighted average. Like I told you when we talked about chapter 6, really the last concept that you'll need to understand to calculate is the lower of cost or market. Okay, so that's what this last one is. So all lower of cost or market is at the end of the year, we need to look at the value of our inventory. Okay, and we don't want it to be over or under value, basically. So we're going to look really overvalued. So we're going to look at our costs, what we paid, and we're going to compare it to the current market price. The current market price is the replacement cost. So what would it cost to purchase those units today? Because depending on which method we used, we could have ending inventory all the way back from the beginning of the year, right? Under LIFO, we could have existing inventory from the beginning of the year. So our costs could be off either way, depending on prices up or down, okay? So all they're giving you is they're showing you the different products that we have, model A through E, inventory levels, quantities, the unit cost, which is our price, what we have them in inventory as, and then the current market value. It's also known as net realizable value, okay? So again, another word for market value is replacement value. Okay. So what we're going to look at is we're going to calculate the total cost for both our cost and the market value, and then just choose the lower of the two. It's really that easy. So hopefully that one will be easy breezy on the test too. So all we're doing here is product A for total cost. We're taking 300 times our cost of 140. Okay. So 300 times $140. Should get a total cost of what, 42,000 for model A. And then the total market, you're going to take your 300 in inventory times the $125. So the total market value is actually $37,500. So which one's lower? Market value, very good. So that's what we would want to report our inventory as. So lower of cost to market is truly looking at our total cost versus the total replacement cost and choosing the lowest one. It's probably one of the easiest accounting calculations we have to do, right? You just pick the lower of the two. Model B, we do the same thing. So 500 times 90, so 45,000. And then 500 times the market value of 112 would be 56,000. Okay. So for model B, our cost is lower, so that's the cost we would choose, the 45,000. And that's what we would report on our balance sheet for that model for inventory. That's the whole point of this, is to value our inventory. This is what we'll report on our balance sheet. Okay. Model C, 150 times 60. So what, 9,000 is our cost. 150 times 59. So the market value is 8,850. 8,850. So there the market value is lower. On D, we have 800 times our cost of 120, so 96,000. 96,000 total cost for D. The market value, 800 times 115, so 92,000. 92,000. And of course that 92, that market value is the lowest. And then model E, we have 400 at our cost of 140, so 56,000. And then 400 at the market value of 145, 58,000. So we would choose our cost of 56,000. So all you have to do is figure out total cost and compare the two. And then we're just going to add it up. So that way we know our total inventory value, okay? So our total cost was what, 248,000? 248,000. The total market cost was 252,300. 350, sorry. 252,350. Mine got cut off there. And then the lower of total cost or total market ends up being 239,350. 239,350. So that last one, that 239,350 would be what we reported inventory on our balance sheet. Any questions on that? Well, that's chapter 6 in a nutshell. Like I said, you'll still want to know how to calculate like sales and do sales minus cost of goods sold to get gross profit. But other than that, I mean, again, your journal entries stay the same from chapter 5 to chapter 6. And I don't know that you'll be doing that many, but just so you know, it's still the same concepts. We're still doing merchandise inventory under perpetual method. The only thing that we're changing here is the valuing of our cost of inventory. Okay? So it's all about the valuation. So all those methods that we learned, FIFO, LIFO, average, weighted average, those are all calculating cost of goods sold. Okay. Any questions? All right. Do it. Pretty simple? Good. Yeah, it's really not too bad.